Hello and welcome to NDTV Profit. You're watching IPO Adda, and my company in focus today is International Gemmological Institute. It's a Blackstone-backed company which is coming out with an IPO which is opening on December 13th, closes on December 17th. Price between 397 to 417 rupees per share. The total IPO size is 4,225 crores, which includes a fresh issue of 1,475 crores. And joining me today is Tehmasp Nariman Printer, who is the MD and CEO of the company, and Ishwar Iyer, who is the CFO of the company. Gentlemen, thank you very much for joining us on NDTV Profit. Tehmasp, it's a unique company, special model. Give us a sense of what does the company do, and so that our investors can understand the business concept and the business model of the company.
Thanks, Ajit, for having Ishwar and me on this cast. See, the main purpose of our organization is to provide transparency. There's such a lot of opacity in the gem and jewelry industry, and our purpose is to provide transparency, and thereby we certify gemstones, diamonds, we do jewelry certification, and we also do color stone certification, we do proprietary certification. So the whole gamut of services and in the business of authentication is done by us. And we've been in India since the last 25 years. I joined the company 25 years ago in 1999, and we've come up to this standard. Initially, I recall that my first year's turnover was just $10,000. Come 20 years later, in 2023, our turnover was $77 million at 83 rupees. The first year's was at 45 rupees. So we've come a real long way, and a year and a half, Blackstone owned us by 100%. And today we are here, sitting here with the IPO. We are on the growth path, and with the ages of Blackstone behind us, we are rapidly increasing our scale up globally.
I would like to understand some more bit on the business front as well, but before that, Ishwar, 1475 crores in fresh issue. What is the purpose of that fresh issue?
See, at the moment, IGI, the way it works, we have an entity in India, we have an entity in Belgium, and an entity in Netherlands. All of these three entities are held by Blackstone. What we are intending to do is get these two entities, which is Belgium and Netherlands entity, to be rolling up under India. So India therefore becomes the holding entity for the group as a whole. So the money that comes in through the IPO proceeds is therefore going to get deployed towards making these two acquisition of these two entities.
So let me get it clear. You're
just
saying.
To add here.
Yeah.
Belgium, since IGI started in Belgium, in Antwerp, the brand, the logo belongs to the Belgium entity, and that itself, by acquiring that, comes into the India entity in one consolidated fashion.
To get it clear, 4,225 crores. There is an OFS in which Blackstone is selling some stake, which is 2,750 crores. And then the fresh issue of 1475 crores, out of which 1,300 odd crores will be used to acquire these two entities which are based out of Belgium and Netherlands, right?
That's right.
Coming back to the business.
2,750 crores this is a stake sale by Blackstone.
Right. Coming back to the business model, how it works, you spoke about the fact that you bring in transparency with respect to certification and accreditation of diamonds, lab-grown diamonds or studded jewelry. Give us a sense of how, what is the kind of revenue model that you have with respect to this accreditation or certification. Is it a fixed cost per for certification, or how does it vary?
No, so first of all, we have an entire comprehensive range of services in the gem and jewelry industry. We do lab-grown certification, we do natural diamond certification, we do jewelry certification. Incidentally, jewelry certification has been invented by IGI. what happens is you have to understand the consumer doesn't buy a loose stone. The consumer buys a stone mounted in a jewelry piece, and we give out 6 million jewelry certs every year. So, and this goes entirely to the end consumer finally. And also we are there in the entire supply chain. Supply chain by means the manufacturer and now the grower, to the wholesaler, to the jewelry manufacturer, and the retailer, the jeweler itself, and finally the end consumer. So we are there completely in the entire value chain. We are there in the comprehensive services, and also we have an extensive global footprint. So that makes us formidable to be one of the best certification bodies in the world.
And what about the revenue model? I mean, how do you earn revenue? Just to get an understanding of your business, is it of course you have software services or solutions that you provide for end-to-end supply chain, but for certification, how do you get the revenue? Because a large chunk of that of your revenue comes from certification.
Right. Ishwar, can you just elaborate on that?
Yeah. So the way our revenue model works is based on the number of reports that we actually issue out for every stone that comes to our laboratory for certification. Our pricing is based on the carat weight of the diamond. It has nothing to do with the final quality of the diamond. And so for every stone that comes in, depending on the size of the carat, we have charges basis the carat weight. So that is how the revenue flows into the organization.
Mm-hmm. So every report you have a per carat charge that you take, and that's how you get the revenue for that.
That's right.
Okay,
That's right.
That makes lifetime understanding about your company. Temas, give us a sense of the market. What the ground reports that we get, we see that there's a lot of slowdown in demand for natural diamonds, and the demand for lab-grown diamonds have gone up tremendously. How are you looking at these trends?
Yes, that's a good question. The thing is, natural diamonds is a little bit on a slowdown. Primarily, why you have the war in Ukraine, and Russia supplies 30-35% of the natural rough, which is now there is an embargo on that. So that is one of the factors. And lab-grown has come of age, and it has taken the world by storm. See, both are diamonds. You have to understand that. I mean, there is absolutely no difference between the two diamonds. And while the entire industry have been heavily invested in the natural diamonds, at IGI our stance was very clear. We are an independent certifying body. We will certify any gemstone which comes our way. We are paid our fee, and we will give the analysis. And because of our first mover in the lab-grown diamonds certification, today we have nearly 65% of the certified lab-grown market globally with us.
So Ishwar, I was looking at your numbers, and I want to post roughly around 58-59% of your revenues are coming from lab-grown diamonds. Do you see that trend to continue even after if there is a truce or a ceasefire that comes between Ukraine and Russia? Do you see that trend to continue, that now that lab-grown diamonds have caught up and people are now going heavily for them?
Yeah, you're right, actually. We expect the trend to continue. The lab-grown diamond is what is propelling this industry forward these days. So we expect that trend to continue. But having said that, in this current year, we're also seeing a strong demand for natural diamond as well. So the growth in India is in surplus of 20% for natural diamond. So we expect that hopefully with the global economy stabilizing in the future, we expect both these levers to therefore fire for us in the future as well.
How are the rates that you charge, or the fees that you charge for certification? Does it vary for natural and lab-grown diamonds, or it remains the same irrespective of which diamond or which stone we are talking about?
No, obviously the pricing is differentiated because the natural diamond is far more expensive, to buy versus the lab-grown diamonds. So our pricing is therefore differentiated between natural diamonds and lab-grown diamonds. Obviously, lab-grown diamond certification comes at a cheaper price versus natural diamonds.
Is there a way you can give us some?
Also, lab-grown is a volume-based.
Yes.
Lab-grown is volume-based, so we also factor in discounts on the base price that we offer for the lab-grown certification. And natural, the price remains stable because it's very rare, it's unique, and there is not much fluctuation in that rate.
Is there can you give us a sense of the kind of differential in pricing that you have for natural and lab-grown to get an idea how expensive, what is the kind of fee structure that you have?
Yeah, see, natural diamonds, our average realization would be just under $50. Against that, the lab-grown realization would be just under $20 per carat.
Okay. Give us a sense of your margin profile. I was looking at your numbers, Ishwar. For the 9-month period, which is September ending, you have a calendar year, financial year. Your margins were around 72% EBITDA margins, but when I was looking at your post-acquisition margins, it came down to 56%. Give us a sense of these two acquisitions that you're doing, Belgium and Netherlands. This seems to be impacting your EBITDA margins post-acquisition.
Yeah, a very good question actually, Sajid. The thing is, while the manufacturing hub is now in India, the other geographies of the US and Europe is very, very critical for us because the largest retail chains, the retail market is in the Europe and in the US. So while each of these locations that we operate in the US and in Europe are having their own laboratories for certification, but the bigger task for the leadership teams there is to engage with the large retail chains there, basis which the business actually comes into India, because all of the polishing and the manufacturing happens out of India. So India is the hub, and therefore we are able to scale up on our revenues at a very, very optimal cost structure. So the teams that are in the US and Europe are therefore entrusted with the task of the marketing and the sales piece, which enables therefore the India business to therefore build on the revenue strength that we have here.
These teams which you're talking about are out of the Belgium and the Netherlands arm?
Sorry, no, what I was trying to say is that to collaborate with what Ishwar was saying, our offices abroad have dual functions. One is to act as a marketing and alliance arm of IGI for India, because India is where the manufacturing happens. However, the retail is in the other geographies. So a retailer, say in the United States, have certain criterias and requirements for their jewelry. So that is translated to our people in New York office, which we get to know what the exact requirement of the retailer in US wants. It's communicated to the vendors, and then we certify accordingly. So basically, they are a very essential part. They're a cost structure, but it's part of the blended EBITDA, if you can see. The other factor is that we have full-fledged laboratories in all these countries. So while a lot of goods which are exported from India are certified, also quite a substantial amount of goods which are non-certified are also exported. So some of these goods which need certification in the various geographies, that is also done by our laboratories, which are there worldwide, and we have a very extensive global footprint on that. So when we merge all that, you have a blended EBITDA of about 56%, but it's the overall EBITDA.
Okay. Ishwar, also give us an explanation why your 9-month post-acquisition profit after tax is lower than the current pre-acquisition profit after tax. Is the two companies that you're merging or acquiring from your parent are loss-making in some way?
Yeah, we had a couple of, we've had some leadership changes in the US. So that consequent to that, we've had some severance pays, etc. that has happened in the US. Consequent to that, that's why the group PAT numbers are slightly lower than what the India number is reported.
Can you give us a sense of these two companies which you will be acquiring from your parent? How big are they in terms of revenue and profitability and margins also?
See, while India contributes to close to around 72% of the revenues, we have the US and Europe put together would be contributing to around 15-18% of the revenues. The balance comes from China and the other geographies where we operate.
And these are profitable and having the same margin profile, or you will have to work on the margin profile to bring it up to your India margins?
No, obviously, when you look at the group number margins at the group level, we are actually lower than what the India margins are, driven by the fact that what Temas just mentioned, that most of the certification happens here in India, whereas these are our marketing and sales arms, which enables us to therefore penetrate into the retail markets there. So the best way to look at our financials is at the total level, given the fact that there are synergies that work here between the India business and the other businesses we have in other geographies.
Temas, can you take us to the synergies there, and what could be the normalized margin level that one can look at, because you have to look at the company post listing with the two new entities being as part of your subsidiaries. So what could be the normalized margin level that one should be looking at?
The normalized margin will remain at around the 55-56 levels, Sajid. So that is, the pro forma financials captures the margin that will be at the consolidated level.
And what about the synergies?
Temas will talk about the synergies in terms of.
See, what happens is when, as one IGI, which is a global body, there is huge synergy among the entire organization. And what happened, while we are extremely strong in the manufacturing sector, we've been in India for the last 25 years, and all the manufacturers and the growers are very well known to us. We also want to merge the retail to the manufacturer. So when this happens, a complete circle is created, and then the flows to the growth.
Gentlemen, it was a pleasure talking to you today. Your IPO is opening on December 13th, closes on 17th of December. 397 to 417 is the price band, and you're raising nearly 4,225 crores from the market, valuing your company at little over 18,000 crores at the upper end of the price band. Thank you for joining us on NDTV Profit. Hello and welcome to NDTV Profit. You're watching IPO Adda, and my guest today is from Inventurus Knowledge Solutions Limited. It's a Rakesh Jhunjhunwala portfolio company. It's involved in tech-enabling platform for assisted physicians and healthcare enterprises in the US, Canada, and Australia. And joining me today is Sachin Gupta, who is the whole-time director and CEO of the company, and Nitya Balasubramanian, who is the CFO of the company. The company's IPO is opening on December 12th, closes on December 16th, price between 1265 to 1329 per share. It's an OFS of 2,497.9 crores, and that gives the company a value of roughly 22,800 crores at the upper end of the price band. Sachin, thank you for joining us on NDTV Profit. My first question to you is to give us an idea of your business model, and just so that the investors understand how your business revenues come from, or where it comes from.
Great, thank you for the question, and thank you for having us on the show tonight. Our business model is all about helping US healthcare deliver better, safer, more efficient care. As you know, US healthcare is the largest industry in the world at nearly $4.8 trillion and growing at nearly 7%, which is faster than GDP. They already spend more than 20% of GDP on healthcare. So there's a fundamental cost problem and opportunity in US healthcare. But compounding that further is a problem related to access to care. where new patient wait times are as high as 45 to 60 days for primary care and really 6 to 9 months for specialty care. And all that is compounded further where quality of care is actually deteriorating because of the administrative burdens that providers are faced with due to the regulatory changes, predominantly the regulatory changes in US healthcare. So at the confluence of all this, US healthcare needs to undergo a significant transformation. And the transformation that we saw coming was a transformation of a care delivery paradigm of reactive hospital-centric medicine to proactive physician-led and patient-centric medicine, where the most important point of care becomes the physician clinic versus the hospital. Why the physician clinic? Because from the physician clinic, the physicians can engage proactively with patients, and especially for patients that have chronic lifestyle diseases, perhaps change their lifestyles to prevent their disease states from worsening and to eventually bend the cost curve that escalates due to utilization of more expensive points of care like hospitals. So as we saw that transformation happening from reactive hospital-centric to proactive physician-led and patient-centric, we decided to focus on that physician segment of the market, which is about a $1.5 trillion industry in the US. So of that 4.8 trillion, about 30% is the physician segment. And we built a business model over the last 18 years that is specifically focused on delegating chore tasks that distract physicians and their care teams from taking care of patients, such that we take away all those chore tasks and enable them to focus on the core of taking care of their patients. Statistics prior to IKS were that physicians, caregivers were spending as much as 50% of their time on non-patient care, non-discretionary tasks. Post-IKS, we give them back 2 to 3 hours of their time, such that even if they took half of that to lifestyle and half of that back to the practice, now they start to dent that cost quality access storm by providing more number of patients care with the same fixed cost, thereby getting more proactive with patients and hence reducing the cost of care and improving the quality of care. Equally importantly, we are able to transform the financials of these large physician practices, which typically were barely 10% EBITDA businesses. By implementing our platform, we can create up to doubling of their earnings by creating another 1,000 basis points of net margin for their business at the confluence of improving their revenue by about 500 bips and reducing their cost by about 500 bips. So a transformative model, and we basically delegate all these tasks through a platform that we've built called our Care Enablement Platform that leverages the proprietary technology that has been written by our 600 plus technologists over these last 17 years and combines that proprietary technology with our global humans predominantly based in India, and those humans supervise the technology and audit the tasks that are being done by technology to make them safe and secure before those tasks are delivered back into the physician enterprise. So at the confluence of leveraging our technology effectively and our global humans, we are able to produce best-in-class operating margins. Over the last 16 years, we built a business model that really has produced industry-leading growth. Over the last 4 years, it's been north of 25%, and even faster margin growth. Our EBITDA margins going close to 38 to 39%. This is a huge TAM because of that $1.5 trillion. These large physician practices are spending as much as 15% of their revenue on these tasks. That makes it a $225 billion TAM, which means that, if you look at this, the Indian offshore software services industry, that's a $250 billion industry today. We found a TAM that is nearly as large as that entire industry. And of that $225 billion, only 30 billion odd has been outsourced so far. So massive growth opportunity as this TAM unlocks, and this 30 billion goes towards the 100 to 150 billion that it inevitably will over the next 10, 15, 20 years. And our business model gives us the chance to leverage our leadership position of the platform that we've built to capture an unfair share of the unlocking of this TAM.
Mm-hmm. Give me a sense of the opportunity with respect to India, because you are primarily focused on US, Canada and Australia. The Indian healthcare market is also organizing itself in a similar model. Do you see an opportunity coming into India? And also give us a competitive landscape. Since you are a platform business, I'm sure there will be other platforms also providing similar services. So give us the idea of how this business is shaping up as the industry expands itself to capture that opportunity.
So I'll start off with your second question first, and then I will come to India, because India is also important in the larger landscape. In terms of the competitive landscape, what happens is when there's such a large TAM across 16 different tasks or features, which we call the chore tasks, that are delegated through the 16 features of our platform, the individual TAMs of many of these tasks itself are very large. For example, we have a task called clinical documentation that we take away from the physician's workflow to alleviate 2 hours of their time that they otherwise spend on clinical documentation. Now, the TAM of just that task is nearly 30 billion. There are other features that have 10, 20, $30 billion TAMs. And as a result of that, many companies got created over the years that were single point solution companies that essentially would delegate one of these tasks or 2 or 3 of these tasks. We saw that as this market consolidated and as the provider behavior matured, they would get frustrated eventually over a period of time with the task of buying 10, 12, 14 different point solutions, integrating them, managing the overhead of 12, 14 vendors, taking accountability of driving outcomes to those vendors, and they would slowly move towards this platform thesis where they realize that the value of the whole platform is much greater than the sum of the individual parts, and they decide to buy more and more of the entire platform. And as a result of that, what we did is we built a company that is not only number 1 or 2 or 3 in each of the features or each of the tasks, but it's probably the only company in the world today that has the full breadth of the platform. So our competitive positioning really is number 1 or 2 or 3 in each of the features, but the only company having the full breadth, which allows us to win today, where there is more dominant point solution buying behavior, but also sets up for winning tomorrow and day after as the buying behavior moves more and more towards the platform. So that's as it relates to the competitive landscape. As it relates to India, obviously Indian healthcare is going to be a huge opportunity in the future. As you know, chronic lifestyle disease as a result of our more sedentary lifestyles is plaguing India as much as it's plaguing anywhere in the world. And so as the Indian healthcare delivery ecosystem matures, as the physician market consolidates, as health insurance becomes more and more pervasive, and health insurance starts to reimburse for physician-based care in addition to hospital-based care, I'm sure a similar model would manifest itself in India, and hopefully at that time, which I think is still several years away, we might be able to leverage all of our learnings from the US healthcare ecosystem to bring them to the advantage of India.
Sachin and Nitya, thank you very much for joining us today on IPO Adda. Your IPO is opening on December 12th, closes on December 14th, price between 1265 to 1329. It's an OFS of nearly 2500 crores, which values the company at 22,800 crores at the upper end of the price band. Thank you for joining us today.